Believe it or not, less than 1% of homes are bought and sold online in the US. E-commerce has been pretty much invisible when it comes to residential real estate transactions. But that could all change with iBuying, which might be the next big trillion-dollar market opportunity and the future of real estate. If you want to be in the know, be sure you subscribe and turn on notifications. Hey there, Dave here. Yeah, I know iBuying does sound a lot like a 90s internet brand, but it actually is the real estate industry term for real estate companies that buy and sell properties through technology, where iBuying companies can essentially cut out the whole real estate agent process and just buy homes directly from homeowners and then sell them directly to home buyers. iBuying has barely made a dent in the real estate market, but right now Zillow and Opendoor are essentially doing for the housing market what Amazon did to retail, bringing the entire process online. So maybe it's kind of like buying shares of Amazon back in 2000 when e-commerce was just 1% of total retail sales. According to Zillow's research, the total value of U.S. homes is $33.6 trillion. And according to Opendoor, 5 million homes are sold each year. That translates to $1.6 trillion per year in volume. The demand for iBuying isn't just limited to corporations. Buyers and sellers want a more convenient experience. In fact, 75 million millennials are entering the housing market, and they expect to transact online. Today, we're digging into both Zillow and Opendoor and another iBuyer player that's going public by SPAC. It's valued at $3 billion. That deal has all the elements: real estate, e-commerce. It's a SPAC. It's led by the co-founder and former CEO of Zillow. Throw in a quick tap to the like button, and I think we've got ourselves a deal. Let's start with Zillow's approach. Zillow is a demand funnel. They are the king of search for residential real estate, and it's actually the parent to other platforms that include Trulia and StreetEasy and HotPads, and people are flooding Zillow's websites. They had 9.6 billion visits last year. Searching Zillow has become a part of pop culture.
You need something new.
Something exciting.
I need a new fantasy.
Then you need Zillow.
But Zillow wants to develop beyond its core function of serving as a display for real estate agents to promote their listings and for buyers to find their dream home. Zillow wants to become an all-in-one real estate transaction platform. Here's a quick breakdown of how Zillow generates revenue. It falls into 3 buckets: internet, media, technology, homes, and mortgages, which sounds like 5, but they lump internet, media, technology into 1, and then homes, and then mortgages. The IMT segment pulls most of its business by offering marketing services and software solutions for agents and brokers. Zillow calls it Premier Agent, and it's basically a sales management and advertising tool, and Zillow makes their money there by the leads it creates. Mortgages are the second of the 3 revenue segments, and due to record low interest rates during the fourth quarter, Zillow's mortgage business remained its fastest growing business segment, up 190% year over year, but it's also the smallest. The third and final segment is where the massive iBuying opportunity lies. We're talking about homes revenue. Zillow has big plans for homes, which brought in $304 million in revenue during Q4 and topped guidance, but it was a 50% drop from a year earlier. It'll take some time to regain momentum for homes. Zillow put its operations on hold as the homes segment continues to rebuild inventory. After halting operations back in March, management expected homes revenue to continue to decline in Q1 of this year before returning to growth in the second half of the year. The success will come down to how effective Zillow Offers becomes. Zillow Offers is the company's new home buying program, which gives sellers a chance to offload their home for an all-cash offer from Zillow in just a few clicks. Zestimate is the key feature here, and it could be the make-or-break ingredient for Zillow's iBuying ambitions. Zestimate is Zillow's estimated market value for a home, computed using both public and user-submitted data. Zillow wants to boost liquidity, transaction volume, and inventory on their platform, so they recently said that Zestimates will act as a standing offer to sell your home directly to Zillow. This could be huge, allowing sellers to sell without much of the friction that's usually involved with the home buying and selling process. But there are challenges here and plenty of criticism of Zestimate's valuations and accuracy. According to Zillow, Zestimate's median error rate for on-market homes across the country is almost 2%. In other words, half of these estimates are within 2% of the ultimate selling price. This number jumps to 7.5% for off-market homes, which are properties that are not for sale. The problem here is that around 95% of the homes on Zillow are off-market. Real estate agents argue that the Zestimate only becomes accurate once a home is listed because it just mirrors the listing price. They do have a point here. There is a lot more information and data that Zillow can absorb once a home is listed, but ultimately, this is a data play for Zillow, and the more mature Zillow becomes in the iBuying space, the more data it will have to create more accurate estimates. It's going to take some time for Zillow's vision to fully develop, but if you believe AI can eventually become more accurate than humans at valuing homes, then the patience could pay off. So Zillow clearly dominates the demand funnel for residential real estate, but Opendoor is the market share leader in iBuying. They accounted for about half of all homes bought and sold online in 2020. These two online real estate heavyweights are going head-to-head to capture online market share, but the digitization of the real estate market is in such early stages that there's plenty of room for multiple players. Opendoor was founded in 2014. It's relatively new to the game, but it's already leaving its mark. The company jumped onto investors' radar at the end of 2020 when it went public by SPAC. That was backed by billionaire investor Chamath Palihapitiya. He has attracted many retail traders. To quote Chamath, he says Opendoor feels like Bitcoin in 2012, Amazon in 2015, Tesla in 2016, and Virgin Galactic in 2019. Opendoor generates its revenue by charging the seller a 6 to 9% fee on the gross purchase price. Any appreciation in the purchase to sale price is just icing on the cake. Opendoor is currently in 21 markets with plans to double that to 42 in 2021. The company says its current playbook will eventually take it to 100 markets, where it will capture 4% of the residential real estate market for $50 billion in run rate revenue. In 2019, Opendoor sold around 19,000 homes. It raked in $4.7 billion in revenue. That accounted for about 1.7% of all transactions in its 21 markets. Citigroup estimates that Opendoor will have 0.7% of the U.S. residential real estate market by 2023. Opendoor, like Zillow, paused their home purchasing in March of 2020 due to the pandemic. That led to a big drop in revenue. For some context there, Opendoor entered the new year with 1,800 homes in inventory and 1,700 homes in contract. It is going to take some time for Opendoor to get back above those 2019 revenue levels, though. Management expects that their revenue is not going to surpass what they did in 2019 until 2022. For the full year of 2020, they sold 9,913 homes. That compares to 18,799 in 2019. After fetching a $3.8 billion valuation in 2019, Opendoor is now valued at nearly $16 billion. Investors giving the company a bit of a pass on its revenue timeline due to tough comps brought on by the pandemic, but they're also shrugging off some major losses, which isn't totally surprising in this market environment where people are paying premiums for growth even when there's no profitability in sight. And here's a quick side note. Opendoor founder Keith Rabois is now on to his next project. This time he's looking to disrupt e-commerce. He has a new startup called Open Store. Wonder where he got that name. But the company's based in Miami. It's reportedly going to buy up a bunch of smaller e-commerce businesses. Zillow and Opendoor are the iBuying frontrunners, but with so much money at stake, other real estate tech rivals are going to be vying for a big piece of the business. One company to watch is OfferPad, and it could prove to be the dark horse in the iBuying race. OfferPad just made the transition to the public markets via a SPAC merger led by Zillow's former CEO, Spencer Rascoff. The deal gives the startup a valuation of $3 billion and adds about $600 million to OfferPad's balance sheet. The company has sold more than 14,000 homes since it was founded in 2015 and currently operates in 16 geographic markets. In 2020, OfferPad generated $1.1 billion in revenue with $5 million in EBITDA losses. One key difference with OfferPad is its emphasis on refurbishing the properties that it buys, which allows it to bump up the resale prices and improve its margins. Some factors influencing the success of iBuying are out of the hands of OfferPad, Zillow, and Opendoor because the U.S. housing market is cyclical and highly dependent on macroeconomic factors, like interest rates. These companies benefited from the strong economic recovery in the market, which saw total transaction value grow by 14% year over year to $1.9 trillion in 2020. And Zillow expects the market to heat up even more in 2021. They're forecasting a 22% jump in home sales and a 10% increase in prices. Home sales and rising prices have been fueled by low mortgage rates, strong demand, and record low inventory. And low rates are not only good for online real estate transactional volume, but also because interest is a major cost of doing business for these iBuying companies. When the companies buy a user's home, they take out a loan and pay interest on that loan. So as rates go up, it puts pressure on margins. Investors have been calling into question whether margin expansion is in the cards over the next few years and if it could put a cap on some of the upside in these stocks. iBuying is a relatively low margin business to begin with, so these companies are going to need to execute in other areas, such as how long they hold onto houses. If they can minimize time on market, that can reduce their interest damage. So the bottom line here is to keep an eye on rates, the impact on margins, and how these companies are working to mitigate any pressure on margins. So what do you think? Is iBuying the future of real estate? Do you trust AI more than humans to figure out what a property is worth? Are real estate agents going to go extinct? Let me know in the comments. I will reply to as many of you as I possibly can. That is the latest from here. I'm Dave Hanson. I'll see you back there for the next Hey There, Dave here.